China today holds roughly $3.2 trillion in foreign exchange reserves, a huge pool accumulated over decades of trade surpluses, export-led growth, and dollar-denominated reserve accumulation. On paper, this gives Beijing enormous firepower, the ability to dump U.S. treasuries, convert reserves into other currencies or assets, or use them to intervene in currency markets. But in reality, selling off those reserves wholesale would be far more painful than it appears for China and for global markets. One main reason is that the portion of those reserves held in U.S. treasuries is far smaller than most people assume. While China remains one of the largest foreign holders of U.S. debt, their U.S. Treasury holdings fell to about 756,760 billion U.S. dollars in 2025, the lowest level since 2009. This means that even if China sold all its treasuries, it would only touch a fraction of its overall reserves. The rest of the $3.2 trillion sits in other assets, currencies, gold, off-balance sheet, shadow reserves, and less liquid holdings. Another critical constraint is self-harm risk. If China attempts to dump large volumes of U.S. treasuries quickly, global bond yields would spike and the dollar could slide sharply. That would erode the value of any remaining dollar-denominated assets China still holds. As one analyst put it, if China pulled out, the value of the rest of its holdings would also fall, meaning any immediate gain could evaporate into losses. Also, weakening the dollar, though it might help Chinese exporters, would raise costs of dollar-denominated imports and increase pressure on China's domestic financial stability. Beyond that, China's export-led economy still depends heavily on the global demand for Chinese goods, demand often denominated in dollars. Abruptly dumping large dollar assets would destabilize the dollar, worsen exchange rate volatility, hurt global trade, and undermine China's own export competitiveness. That interdependence means China and the global economy are locked in a delicate mutual balance, not a simple dollar reserves war. China has therefore gradually shifted toward a more diversified reserve strategy rather than a dramatic wholesale dump. Since about 2022, Beijing has been steadily reducing its holdings of U.S. treasuries and increasing allocations to gold and other strategic assets, a hedge against geopolitical risk and dollar volatility. This slow pivot preserves stability, protects remaining dollar assets, and avoids triggering market chaos. Moreover, the institutions and global demand supporting the dollar remain massive. The U.S. Treasury market is the largest and most liquid in the world. Domestic U.S. investors hold roughly 75 to 80% of all U.S. debt, meaning foreign holders, including China, lack the leverage to disrupt prices significantly. Because of this, any attempt to weaponize reserves by mass sell-offs would likely cause greater harm to China itself than to the United States. In effect, China cannot simply cash out or throw the dollar overboard. The $3.2 trillion reserves are not a free, liquid war chest, but a complex web of assets tied into global financial stability, domestic currency policy, and China's own export-dependent economy. So long as China remains integrated with global trade and depends on dollar-denominated flows, its reserves serve more as a buffer and insurance mechanism than a leverage weapon. That is why the idea of China dumping all its reserves tomorrow remains more myth than reality. The constraints, self-inflicted market damage, devaluation of remaining assets, economic blowback from export disruption, make full-scale sell-offs irrational. The $3.2 trillion still matters, but not as a bomb, as a cautious shield.